Someone can have $8,000 of available credit and feel free. Someone else can have $8,000 in savings and feel trapped. Same number on a screen. Completely different emotional reality. And that difference is exactly why debt can feel richer than savings, even when it's quietly making you poorer. Money is money, a dollar is a dollar, regardless of where it came from or what it's attached to. At least, that's how it works on paper. In the brain, it doesn't work that way at all. The brain doesn't evaluate money as one single, interchangeable resource. It sorts it into separate mental categories, and those categories feel completely different, even when the actual numbers are identical. A dollar earned, a dollar saved, and a dollar borrowed are mathematically the exact same dollar. Psychologically, they might as well be three different currencies, each with its own exchange rate against how safe or dangerous it feels to spend. This is called mental accounting, a concept developed by economist Richard Thaler to describe how people unconsciously assign money to different psychological buckets: rent money, fund money, savings, emergency funds, and treat each bucket by its own separate set of rules instead of evaluating their overall financial position as one connected whole. Thaler's original research found the effect in places that seem almost too small to matter. People who would never dip into a vacation fund to cover a parking ticket, even when the two buckets sit in the exact same bank account. Accessible with the exact same card. The money doesn't know it's been labeled. The brain does, and it obeys the label anyway. Available credit falls into a strange bucket of its own. Because a credit limit is immediately accessible, a number you can spend right now. Without waiting, the brain often files it under money I have rather than money I will owe. Savings, on the other hand, sit in an almost opposite bucket. Money that's technically available, but mentally earmarked as off limits, protected, not to be touched. The result is a strange inversion. The money you actually own quietly gets treated as untouchable, while the money you don't own yet and will have to pay back, often with interest, gets treated as spendable. This inversion has a name too: the fungibility illusion. In theory, money is fungible. $1 can always be swapped for another, regardless of source, and a rational accounting of your finances would treat $8,000 of credit and $8,000 of savings as mirror images of each other. One an asset and one a liability, canceling out to zero. But brains don't do rational accounting by default. They do labeled accounting, and the label available carries almost none of the psychological weight of the labeled debt, even when they describe the exact same transaction from two different angles. This gets reinforced by liquidity framing. A high available credit limit feels expansive and safe in the moment, almost like a cushion. It doesn't feel like debt until a purchase is actually made, and even then, the bill doesn't arrive for weeks. Savings, by contrast, feel finite and depleting the moment you imagine spending them, because withdrawing from savings is immediate and visible in a way that swiping a card simply isn't. The effect shows up clearly in the data. Federal Reserve research published in January 2026 found that about 12% of U.S. credit cards receive a bank-initiated limit increase every year, and when that happens, the customer's revolving debt typically rises by an amount equal to roughly 30% of the increase, even among people who weren't anywhere near their old limit. A separate, widely cited study by economists David Gross and Nicholas Soleles found people typically spend an extra 10 to 15 cents for every additional dollar of available credit, regardless of whether their income or financial situation changed at all. The credit limit itself, a number most people never asked for and rarely examine, is quietly doing a lot of the spending on their behalf. There's also an emotional weighting difference. Losing money you've saved watching a balance drop triggers loss aversion almost instantly. It feels like something is being taken away. Spending on credit doesn't trigger that same feeling, because nothing appears to be lost in the moment the number in your bank account doesn't move at all. The cost is real, but it's been pushed into the future, disconnected from the emotional signal that would normally accompany it. This is part of why credit card debt is so much easier to accumulate than it is to notice accumulating. Every individual swipe produces almost no emotional signal at all, while the eventual reckoning a statement balance that's grown for months arrives as one lump sum, disconnected from any single decision that caused it. Consider two people with an identical net worth, $8,000 in debt, offset by $8,000 in savings, for a real financial position of exactly zero. One checks their credit card app and sees available credit, plenty of room, plenty of options, a sense of financial flexibility. The other checks their savings account and sees a number they're mentally protecting, afraid to touch it in case something worse happens later. Same net worth. Opposite emotional experience. The credit-focused person is more likely to keep spending, reinforcing the exact debt that's dragging down their real financial position, while feeling the entire time like they're doing fine. Push the comparison further and it gets stranger still. Give the credit-focused person a sudden windfall, a small bonus, a tax refund, and watch what happens. It rarely goes toward the $8,000 balance sitting quietly on the card. It tends to go into a new bucket entirely. Extra money, free to be spent on something enjoyable, because it doesn't feel connected to the debt bucket at all, even though paying down that balance would have been the single highest return use of that exact sum. Meanwhile, the saver, sitting on the identical $8,000, treats even a modest windfall as something to protect further, adding it to a pile she's already reluctant to touch. Neither behavior is about willpower. Both are the buckets doing exactly what buckets do, keeping money in its assigned lane, regardless of what the lane actually costs. This is precisely why net worth assets minus debts, the one number that actually reflects financial reality, feels so much less emotionally vivid than either bucket on its own. It requires holding both numbers in mind at once and doing subtraction, a step most people don't take in the moment of a spending decision, because neither bucket naturally invites comparison with the other. Financial apps make this worse by design, not by accident. A credit card app shows available credit front and center in a bright, encouraging number. A savings app shows a balance that only ever moves down when you touch it. Neither screen ever shows you the one number that would actually tell you the truth, because that number requires opening two apps and doing math nobody asked you to do. A simple corrective habit. Whenever you check your available credit, force yourself to also glance at total debt and net worth in the same moment, rather than letting the credit number stand alone. Some banking apps let you set this up as a single combined view. The goal is to interrupt the mental accounting split before it happens, making it harder for available credit to quietly feel like money I have without the debt attached to it in your mind at the same time. Debt and savings will never feel the same, even when they cancel each other out exactly. But feeling rich and being rich are two very different measurements, and only one of them shows up on a bank statement that actually matters. The version of you that feels flexible because of available credit, and the version of you that feels stable because of unspent savings are, in the coldest financial sense, standing on identical ground. Only one of them knows it. If your own numbers just got a little clearer, that's the goal here. New breakdowns like this drop every week. Do you actually know your real net worth right now, debts included, or just the number that happens to feel good today?